Bond yields are reaching new multi-year highs ahead of Jerome Powell's talk at the Economics Club of New York tomorrow morning. So just why are yields going quite so high? No surprise why oil is higher today as tensions mount further in the Middle East. And closer to home, how was Michele Bullock's fireside chat yesterday? Are things getting hotter at the RBA? And will today's employment numbers add more fuel to that fire? It's Thursday, the 19th of October, 2023. It's the morning call from NAB. Good morning. Well, bond yields pushing higher again, another 7 basis points on 10-year treasuries, up to 4.9%. They got up to 4.93% during the session, so 5% sometime soon. Doesn't seem out of the question, does it? UK 10-year gilt yields are up 15 basis points, up to 4.65%. Aussie 10-year yields up 10 basis points yesterday, up to 4.65%. Then add another 6 or 7 basis points on futures overnight on top of that. And shares are down in the US at close, 1.6% off the Nasdaq, 1.3% off the S&P 500, 1% down for the Dow in Europe, 1.1% off the FTSE 100 and the Euro Stoxx 50 at close. Oil prices are up, 1.7% added to Brent, around 91.50 a barrel now, 1.9% up for WTI. The US dollar is up 0.3%. The Aussie dollar is down 0.4% to 63.4 US cents. The euro also down 0.4%, about the same for the pound as well. And NAB's Ray Attrell joins me today in Sydney. So, yeah, more movement up in yields. What is the real driving force for these yields? Is it purely central bank expectations? Is it because we've been seeing quite a lot of bond issuance in the United States lately? We've also got QT. You can't say all of the above. You can only pick two. What is it that's the real driving force here?
I'm going to pick one today. Morning,
okay,
Phil.
good.
Oil.
Okay, that wasn't an option, but okay, fair enough.
There's an other box. There was an other box in that questionnaire, wasn't there?
Okay, but, sure.
Anyway, that would be, just trying to. There's a lot of moving parts to markets and a lot of movement across whether it's equities, currencies, or bonds. But if we're trying to distill it down to sound bites, which I guess is part of our job, certainly another what is it? Is it $2 or so on the oil price? I think, and I've seen that the Iranian foreign minister has been out calling for a full and immediate boycott of Israel by Muslim countries. Obviously we've had the Joe Biden, declaring that as far as they're concerned, they're taking Israel at its word that the atrocity in the Gaza hospital was not of Israel's making, etc. But certainly tensions are clearly even further inflamed, if that's possible, and. It's certainly showing up in oil prices.
Although not, oil up but less than 2% at this stage. So it's not.
Sorry, I meant 2%, not $2 anyway. No, absolutely. But certainly it's a considering it's a risk-off day. So look at equities; they're down a lot. And yet we've got bond yields higher. Now, the other thing probably to mention is that markets were anticipating a potentially poorly received 20-year bond auction. And as it turns out, that's actually come a little better than expected. It's cleared about over a basis point lower than where the 20-year bond was trading in the market prior to the auction. So we have actually seen something of a reversal. We do have generally a steeper curve, certainly out to 10 years on the day, yields up sort of 3 to 5 basis points higher, but they're back a fair bit from the lows. So that 20-year bond was trading at just above 525 prior to, or closer to 526 prior to the auction. And last I looked, it was down about 520. So we have seen a little bit of a reversal there, and not coincidentally, I would suggest the dollar is off its peaks, and equities had certainly pulled back off their lows in the sort of half an hour after the auction. But that's more a description of price action than what the causes were. But I think the bond market is still kind of front and center at the moment as far as the currency and equity markets are concerned.
Mortgage rates shooting up now. 7.7% according to the Mortgage Bankers Association. MSNBC is quoting the US Mortgage Daily News Index, which has got it at 8%, whichever way it's the highest since July 2000. And yet housing starts are up. Building permits didn't fall as much as expected, but presumably we're going to see the consequences of that because we get existing home sales for the US later on today. Who's going to put their house on the market when they know they've got to get another mortgage at 7.7 or 8%?
Absolutely. That is the issue, isn't it? Which is why, starts are doing better. Though even there, given that, buying a new house with a mortgage at the new 30-year rate is not particularly appealing either, is it? But there's been a huge amount of month-to-month volatility in housing starts. But as you say, I think it's the existing home sales that shows up the reluctance of people to consider moving house if they've then got to hand in their 30-year mortgage with, a 2% in front of it and swap it for something with a 7 handle.
Yeah, well, that would certainly take a bit of money out of your pocket. But generally, I mean, we've talked about how the US is holding out. We've got the beige book out this morning, though, saying little change in economic activity since the September report. The near-term outlook might be slightly weaker growth. Prices continue to increase at a modest pace overall, particularly for the services sector. And now companies are less able to pass on those increases, it says. So they're feeling that in their margins, which is not good for those companies, but obviously good for keeping inflation down. I mean, there is nothing too surprising there, except for the fact that, nothing is moving in a radical fashion in either direction, is it?
That's right. No, I'd suggest that the beige book is particularly beige this month. And I don't think it really informs us about what the Fed is minded to do, although there's quite a few Fed speakers overnight and rather important one tonight. We can touch on in a second. But the other thing they do note is that labour market tightness continued to ease across the nation. So I think that was of some note as well. So I think it all sort of militates to a wait and see approach as far as the Fed is concerned. But let's see what Mr. Powell has to say.
Yeah, well, so on that, because that is early tomorrow morning, he's going to be talking. So is some of the increase that we've been seeing in bond yields, is it down to the anticipation of what he's going to say? Because we have had some people from the Fed who've been fairly hawkish. There's some wait and sees, but is he going to be just mirroring that hawkishness? Do you think? No?
I think I'd take the other side of the argument about hawkish Fed members talking hawkishly. And we've had John Williams, one of the big heavy hitters at the FOMC, saying only that we're going to stick at it to make sure that we really achieve the goal of 2% on a sustained basis. He's also said he's not yet convinced that the neutral rate is higher, but his comments I think are more consistent with wait and see. Fed Governor Waller, who's also been an erstwhile hawk, said, "I believe we can wait, watch, and see how the economy evolves before making definitive moves on the path of the policy rate." And Fed Governor Bowman, who a couple of weeks ago was pressing the case for potentially at least 2 more rate rises, saying that inflation's come down but still too high, etc., but made no specific comments on the Fed's next steps. So I'm expecting that Governor Powell will be giving a sort of we can afford to sit on our hands a little bit longer. So in answer to your question, whether anticipation of Powell is the reason for high yields.
Well, obviously not. But does that mean then that we're going to see yields come down after he's spoken then?
Well, to the extent that yields haven't gone up because they're anticipating a Powell speech, then they shouldn't be going down if they don't get one, I suppose.
Yeah, I guess so. I follow that.
But let's see. But it is to the Economics Club of New York, which is usually a pretty keynote one. So all the great and the good of the Wall Street investment houses will be there. So it'll be a fairly high-level macro discussion for sure, with probably some very pointed questions, I would suggest, from Wall Street economists.
Well, I tell you what, the RBA has been more hawkish then, haven't they? We talked about the hawkish minutes from the RBA yesterday with its lower tolerance for a slower return to inflation, getting inflation back to target. Since then, Michelle Bullock has given her fireside chat. So what did she have to say?
Well, I think she's continued in the theme of sort of a hawkish tilt. Is that the way to describe it? We had comments from Chris Kent, the assistant governor, last week that we certainly interpreted that way. And obviously there were some specific sentences in the minutes of the October RBA meeting published earlier in the week that were in the same vein. And then I think the sort of killer sentence, if you like, from Michelle last night was that there's a few things that are suggestive that it's going to be difficult to get inflation down, and services inflation in things like takeaways, hairdressers, restaurants, those sorts of things, that inflation is running a bit above 4%. So it's above our target and it's pretty sticky. And that's what we're observing overseas as well. So, I think that is, I won't say it's a clear statement of intent as to what the RBA might be minded to do, but I think it does sort of, plays to the view that if we do see an upside surprise relative to the RBA's own forecast in next week's Q3 CPI forecast, which, you've been talking about with Tapas and others, and that's what we do expect, then I think that might well seal the deal as far as the RBA lifting rates out of the November meeting.
Yeah, so the RBA annual report is out today as well. I'm not really quite sure if there's much in there. I mean, you can have a dip in and have a look and see how much Philip Lowe got paid last year, 5 times as much as Michelle Bullock in the report the previous year, just as an aside. But what about if we're saying that bonds aren't being driven by the data right now, it's more to do with oil? Well, UK CPI, I mean, that has to be part of why UK gilt yields are up so much. They're up 15 basis points. And yet, the inflation, just arguing against myself here, the inflation number, the core CPI, was down on last time, but not by much, from 6.2% year on year to 6.1%, 1/10 of a percentage higher than expected as well. But that is quite a response. So obviously a chunk of that response in yields is also the oil story and the international concern around it.
Well, I think so. It's probably feeding off the rise that we've seen in the US market. But yes, there was a little bit of reaction. The only thing probably I'd note is that, yes, the numbers have come in 1/10 above expectations on both the headline and the core, as you say. But those numbers are actually a little bit below the Bank of England's August monetary policy report forecasts. I think by 0.2 on the headline and 0.1 on the core. So, in that sense, I don't think this is new information for the Bank of England that would be, sending any alarm bells racing in the portals of Threadneedle Street as far as the risks of a resumption of tightening after that decision to pause earlier this month.
And China's growth for Q3 was higher than expected, 4.9% year on year. I mean, there's some base effects going on there, aren't there? But so maybe it's better to look Q on Q, which is 1.3%, which is well up on 0.5% for Q2. So where is that growth coming from?
But, mostly coming from consumption. That's the number. I mean, I have to say that, 1.3% quarterly growth up from 0.5% in Q2 has raised a few eyebrows as to whether we really did see that much of an acceleration coming through. As you say, the year-on-year numbers are actually down on Q2, but Q2 this year, benefited from the very low base effect from Q2 last year at least. But certainly retail sales was the standout in the monthly September numbers, jumping to 5.5% from 4.6%, well above the 4.9 consensus. So it really is very much a sort of consumption-driven thing, which is a good thing. Certainly suggests that activity was a little stronger than maybe some of the anecdotal evidence suggested during the holiday period. Fixed asset investment, though, remains relatively subdued, and in terms of feedback to Australia and demand for commodities, etc., that wasn't a particularly bright spot, at least. But industrial production was picking up, and amid some evidence that sort of demand for exports and the rest of the world from China has improved. So overall, I think the numbers that are consistent with China achieving its 5% growth target for this year, and the message wasn't lost on the Australian dollar. So I think the combination of those numbers and that sort of more hawkish rhetoric that's coming out of the RBA and repricing, certainly lifted the Aussie dollar. But as we've seen overnight, it's been another case of sort of up the stairs and down the elevator with broad dollar strength and risk-off markets taking us back closer to 63 cents.
Well, the big number today, obviously, is Australia's September labour market data. So just how tight is the labour market, and is it inflationary?
Whether or not we're seeing some easing in the labour market, there's perhaps some very tentative signs, but we're looking for a 30,000 rise in employment in September. That's about 10,000 above the Bloomberg market consensus, at least. But the unemployment rate we think will be sort of stable at 3.7%, with the participation rate also unchanged at around 67%. Those are in line with market consensus. Now, the RBA's August statement on monetary policy had the unemployment rate averaging 3.9% in Q4. So these numbers are only for September, remember. So if we get an unemployment rate of 3.7 or a little bit higher, I think the RBA would consider that to be consistent with their forecasts. But if we get numbers that are stronger than that, and let's say the unemployment rate dips down, then I think it would put the risks firmly on the side of a sort of tighter for longer labour market relative to the RBA's last forecast. So, at the margin, again, I think it would be supportive of the idea that if the labour market isn't loosening up quite as quickly as the RBA thought, that also falls on the side of the ledger that militates in favour of further rate hikes.
Well, on the US, their labour market, we get the initial jobless claims tonight, not moving in any great fashion, it seems, from week to week, and the Philly Fed manufacturing index as well tonight.
Yeah, all relatively second-tier data, I would say. Obviously, that low level of claims continues to point to the ongoing resilience of the labour market.
Sure does, doesn't it? Well, that'll do for now. Good to talk, Ray. We'll catch you again very soon. Thank you.
Well, thanks, Phil.
And just very quickly before we go, Netflix have done well in their third quarter results, announced just after the US closed this morning, adding 8.8 million subscribers after their clampdown on password sharing. People still wanted it. 8.5 billion revenue is roughly in line with expectations. Profits rose 20%, and they're going to push their prices up higher. So more to come. Whereas Tesla, well, they've been cutting their prices. They saw revenue in the third quarter up 9% to 23.35 billion, which is a bit below analyst estimates of 24.1 billion, and slimmer margins, 17.9% for the quarter compared to 25.1% a year ago. That's it for the morning call for today. I'm Phil Dobby for now. Back again tomorrow morning. I'll see you then. Thanks for listening.